This episode is brought to you by Shopify. Upgrade your business with Shopify, home of the #1 checkout on the planet. Shop Pay boosts conversions up to 50%, meaning fewer carts going abandoned and more sales going cha-ching. So if you're into growing your business, get a commerce platform that's ready to sell wherever your customers are. Visit shopify.com to upgrade your selling today.
This episode is brought to you by Ring cameras and doorbells. A lot happens while you're away from home. That's why Ring makes it easy to check in from anywhere. Whether you're saying hi to an unexpected guest, making sure those packages are safe, or keeping your pets company while you're out grabbing groceries. It's all a few taps away, right from your phone. Be there with Ring. Explore cameras, doorbells, alarm kits, and more right now at ring.com.
This is Optimal Finance Daily. Why does anyone invest in expensive funds? By Kevin Ha of financialpanther.com. And I'm your host and personal finance enthusiast, Diana Merriam. Welcome back to Optimal Finance Daily, where I'm here with you each and every day, reading from some of the world's best personal finance blogs. So with that, let's get right to today's article as we optimize your life. Why does anyone invest in expensive funds? By Kevin Ha of financialpanther.com. One of the things I've always wondered is why anyone would invest in expensive mutual funds. I typically define an expensive fund as one with an expense ratio of around 1% or more. Since there are many mutual funds with expense ratios of 0.1% or less, it's never made much sense to me why anyone would invest in anything else. Why pay 10 times more to invest your money in what amounts to basically the same thing? One problem I have is that as someone who's really into personal finance, I fall into a sort of personal finance bubble. I take a lot of the stuff I know for granted and assume that everyone just knows this stuff too. In reality, the vast majority of people have no idea what anything I said even means. I was reminded of this fact recently when I was talking to my brother about what he's investing his money in. It turns out that he was entirely invested in funds with a big name financial services company, all with expense ratios of at least 1%. After a little bit more digging, I discovered that he gave his money to a guy he knows at this big name financial company, who then put the money to work for him. As my brother explained to me, he went to the guy, gave him his money, and said, "Make it grow." My brother's a smart guy. He's always been good at earning and saving money. But when it comes to investing, he's not particularly knowledgeable. All of the basic terms that personal finance people talk about, expense ratios, 401ks, asset allocation, etc., are gibberish to him. And he has absolutely zero interest in learning about any of that stuff. Needless to say, I wasn't too happy with his investment choices. Financial Panthers don't invest in expensive funds like that. But my brother's situation showed me exactly why people still invest in these types of funds. The reason people invest in expensive funds. Ultimately, the reason people like my brother still invest in these expensive funds instead of opting for cheaper alternatives stems from a lack of knowledge. It basically boils down to 4 reasons why someone invests in these, essentially rip-off funds. Number 1, someone told you to invest that way. There's nothing wrong with getting expert advice, especially in areas where you're not all that knowledgeable. At the same time, though, you really need to take the time to scrutinize where your advice is coming from. Not everyone has your best interests at heart. I don't know enough about why my brother's guy put him in the particular funds he's invested in. The only thing I do know is that they don't seem to be particularly smart investment choices. My guess is that there's a commission or something else involved. It's the only explanation I can think of for why a professional would pick funds like these. Number 2, picking funds based on brand name. Going with brand names when it comes to investing isn't necessarily a bad thing, mind you. Vanguard, for example, is a brand name I trust, and if I knew absolutely nothing about your investment choices, I'd say you can't go wrong picking something from Vanguard. At the same time, I've always seen funds in my employer-sponsored plans that seem way more expensive compared to the other options. I never understood why anyone would invest in those funds, but my guess is that people see the brand name and just decide it must be good. Number 3, thinking administrative fees are the only fees you pay. One thing my brother told me to justify his investment choices was his belief that his investments were cheap. When I told him they were way too expensive, he explained to me that he only paid $7 per year in order to invest. Setting aside the fact that I don't think that number is accurate either, it's not uncommon for people to think they're paying very little or even nothing in fees. But everything you invest in has to have some internal costs. Most people don't even realize that their 401k plan isn't free. In this case, my brother sat in these funds because he didn't realize that his investment choices carried internal fees much higher than other alternatives. And number 4, thinking they can beat the market. I know most of us personal finance dorks know that the vast majority of funds will not outperform the market. Still, there are a shockingly high number of people who think that consistently beating the market is possible, as if we can all be Warren Buffett. Do yourself a favor and don't try to beat the market. You don't need to beat it anyway. Good enough is all you need, and being average will do you just fine here. What are your alternatives? So what's a guy like my brother to do? He's got well over $10,000 to invest. If he wanted to, he could basically invest with rock bottom costs. The simplest thing to do would be to invest his money with reputable, low-cost alternatives. Naturally, anything Vanguard would do. If he wanted to make it really easy, he could even invest all of his money into something like the Vanguard Total Market Index Fund, or VTSAX, and call it a day. With an expense ratio of only 0.05%, he'd be sitting pretty well. Another potential option would be to go with the Fidelity Total Market Index Fund, or FSTVX. It's basically the same thing as the Vanguard Total Stock Market Fund. Again, with an expense ratio that low, you really can't go wrong. Even investing in just those funds might be too complicated for my brother. Remember, he has absolutely no interest in learning about this stuff and would rather someone just do it for him. Instead of giving the money to his guy and telling him to make it grow, he could just go with a robo-advisor such as M1 Finance. They don't charge any management fees and will help novice investors have a good, low-cost, diversified portfolio. Takeaways. It's easy to get mired in analysis paralysis, so don't get too caught up in trying to save a few tenths of a percentage point in expenses. But you've got to do some due diligence. To be fair, 1% in fees probably won't be the reason you don't reach your financial goals. If you're not going out and saving as much money as you can, it really doesn't matter what your investment expenses are. But it's still easy enough to just avoid those expensive funds altogether. My brother doesn't need to be in these types of funds. It's just a waste of money. And really, to be blunt, he's being scammed. Don't just trust a guy out there to invest for you. If you want to make it really easy on yourself, go with something I listed in the alternatives. This investing stuff doesn't have to be hard or expensive. Save your money and use it on the more important stuff. You just listened to the post titled, "Why Does Anyone Invest in Expensive Funds?" by Kevin Ha of financialpanther.com, and I'll be right back with my commentary. Buy low, sell high. Buy low, sell high. It's a simple concept, but not necessarily an easy concept. Right now, high interest rates have crushed the real estate market. Prices are falling and properties are available at a discount, which means Fundrise believes now is the time to expand the Fundrise Flagship Fund's billion-dollar real estate portfolio. You can add the Fundrise Flagship Fund to your portfolio in minutes by visiting fundrise.com/OFD. That's FUNDRISE.com/OFD. Carefully consider the investment objectives, risks, charges, and expenses of the Fundrise flagship fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/OFD. This is a paid advertisement.
This episode is brought to you by Shopify. Upgrade your business with Shopify, home of the #1 checkout on the planet. Shop Pay boosts conversions up to 50%, meaning fewer carts going abandoned and more sales going cha-ching. So if you're into growing your business, get a commerce platform that's ready to sell wherever your customers are. Visit shopify.com to upgrade your selling today.
Fees can hit you from a couple of different angles. There will always be an expense ratio for the investment, as described in the article today. But on top of that, you could also be paying AUM fees, or assets under management fees, to an advisor who's choosing to invest your money in funds with high expense ratios. Fees compound just as much as interest compounds, and so the effect is dramatic over time. For example, a DIY investor could invest in a low-cost index fund like VTI with a 0.04% fee and pay less than 1% of their portfolio in fees over 30 years. Alternatively, someone like Kevin's brother could work with an advisor who charges a 1% AUM fee and chooses to invest in an expensive fund with a 1% expense ratio. This 2% fee will eat up 30% of this portfolio over 30 years. If you're not comfortable choosing these low-cost funds on your own, I highly recommend that you consider a flat fee advisor. This is different from fee-based, fee-only, or commissioned-based advisors because they don't manage your investments for you. They basically work with you on the financial plan and show you how to implement that plan yourself. And you're paying them a flat fee for their time and knowledge. And that'll do it for another edition of Optimal Finance Daily. Thank you so much for joining today and every day. And I'll be back again tomorrow. So I'll see you there where your optimal life awaits.